skills required for prudential regulation and market conduct regulation are quite different. Getting staff, getting employees to build that skill over a period of time and creating the culture is a huge challenge, especially in emerging markets. And also on the other side of the equation, it's really the market forces the question onto the regulator because there's ambition, especially in a country as large as China. Do you see that that regulation itself should be evolutionary?
Yes, I mean, you assert that the skills are very different. I don't believe it, and I've run an institution with them in it. That if you're regulating an investment bank, for example, you need people who understand the capital of the investment bank, but who also understand the issues of insider dealing, how information is held. You know, when you're looking at an investment bank dealing with a merger and acquisition, for example, and providing finance to it, you know, you need to look at the risks involved in that and the capital requirements. But equally, you need to look at the relationships they have with the client. Are they engaged in share support operations which are unlawful? That is all got to be looked at together. In the bank, it's all looked at together. So I don't understand that these are completely separate skills. I just don't. That's not the way that we did it in the FSA. We don't see that argument, so don't believe it. However, your second point is the question of evolution. Yes, exactly. I think you do need to evolve. And let's take a very simple case. Some African countries where they don't really have a securities market and where almost all of the banking is done through the banking system, and also perhaps where creating independent institutions is difficult in a one-party state. At that point, if you say to me, what's your advice on regulatory structure? I'd say leave it all in the central bank, because the central bank's likely to be the nearest thing you have to an independent institution. It's essentially the whole financial intermediation is banking anyway, so you can look at the whole thing from the central bank perspective. Probably also they've got controls on interest rates and credit controls which they're administering through the central bank. I'd say the case for an independent regulator is very small. I just wouldn't do it, and I've been asked several times, and true in some Caribbean countries as well. But as soon as you start to get a more sophisticated market and you open up your equity market and you have foreign investors coming in and you have separate insurance systems as well, then you have to try to think about evolving your regulatory system to match the sophistication of those markets. So then you might say, well, we're going to need separate regulators because we're allowing separate markets to develop. And then if you get further, like in the UK, and you sort of allow it all to merge, then you probably need your regulatory system to merge again. So undoubtedly there is a kind of evolution. But I really think it's important to say market structure first, decide what you want there, and then think about what the regulation should be afterwards, not the other way around.
One country that we didn't talk very much about and where a lot of developments are taking place today is the US itself. TARP and SCAP and all of these risk management models that they're throwing into the works in order to try and deal with the crisis that they have. Do they represent new best practices that will influence the way in which other countries will start dealing with banking crises?
Well, they may be. I'm not sure if they're best practices. They may be reasonable practices to deal with a crisis. But I think that even the US authorities who designed them wish they hadn't had to.
Right.
And so I think that they will not be permanent templates for the future. I think as soon as they can wind them down, they will.
The interesting thing about the people who designed them is they're basically politicians and they're not regulators.
Well, I think that's partly true, let me say. I think that the design of the support packages was primarily done by the Federal Reserve in New York and to some extent the Treasury. But of course in the political process they've had all kinds of things added on to them because Congress, not unreasonably, says we're not going to give these guys more money to spend and throw away and pay themselves unless we control things like remuneration and risk, etc., on top of it. So the essential support package was done in order to bail out the banks and allow them to carry on lending. And then the extra bits have been tacked on by political.
What do you see to be the most important component of the regulatory reform that should take place in the US?
Well, there are a lot of things I'd like to see happen in the US. I'm not sure all of them
Just
are going
the structure.
to. The structure, I would say, one is I think there should be a federal insurance regulator. Because let's not forget that AIG is possibly the most embarrassing thing that's happened. And that's cost a huge amount of money. And AIG was regulated by the New York State insurance regulator and by the Office of Thrift Supervision.
Right.
And that can't be right. So I think that's what I would do first. Personally, I would merge the SEC and the CFTC. The US is the only country in the world which tries to regulate cash, equities, and derivatives in separate agencies,
right.
And no one else thinks that makes sense.
Right.
And I also think that the idea of a single financial stability regulator makes some sense. Personally, I'd be happy for that to be the Federal Reserve, but there's some arguments going on about that. So I think those are the three areas in which I'd like to see change.
The Financial Stability Board, is more members a good thing, or does it have to be more representative of very representative countries?
Well, in every part of the world's governance, whether it's the UN Security Council or the WTO or the Financial Stability Board, you've got a balance to strike between representativeness, which would tell you wanted 192 countries in, and then ability to make decisions, which might tell you wanted one country in. But clearly you've got to strike a balance between the two. Now, I think that up to now, the balance has probably been too small, because actually the G7 was no longer representing the real weight of the global economy. I mean, how can you argue that Canada and Italy should be in and not China and India? I mean, it doesn't make any sense.
Right.
So clearly that had to change. Personally, I would have not gone as far as the G20, because I think there are some countries there who are not significant in terms of global financial markets. The original definition of the Basel Committee was that it should be members from countries who had internationally systemic banks, which is sort of a good idea, basically,
right.
Because that's what you cared about. And I think actually the Financial Stability Board should have been designed like that, which will have on it countries whose financial markets are sufficiently important that they influence other people's financial markets,
yes.
Which tells you Singapore and Hong Kong should be there as they are. It tells you China should be there. It tells you Argentina shouldn't be there. But at the moment, that game has been lost. So we've gone to G20, and we'll just have to make it work.
Basel I, someone told me, took a day to decide. And Basel II took 10 years, and they're still not there yet. What would you like to see the Financial Stability Board achieving?
Well, I would like to see them achieving some discipline on this process, really. At the moment, there is no authority in the system. This was a point I made in a book I wrote last year about international regulation, that all of these different bodies are in theory independent from each other. There's no authority and no discipline. And the single most important thing the G20 can do is to create some continued discipline in the system. So the G20 holds the Financial Stability Board to account for a revision of banking regulation with deadlines. That then tells the Basel Committee, you've got to deliver this, Basel III or whatever, by this date, and we want the best you can do by that date and not a perfect thing in 15 years' time, and holding them all to account, and that's what's needed.
So Howard, I hope that this will be a continuing conversation, and we'll keep coming back to you for ideas and how that's going to work. Thank you very much.
I'd be happy to continue the conversation.